Hi there, welcome back. This is the last lesson before the holidays. The course will continue in the second week of January. In this last lesson, we will conclude what we have to say, at least the very basic things we are saying, about credit risks. Credit risk is a rather complicated subject for which you can have many courses, many specialized courses. Now, today what we will do is to discuss two models, Moody's KNV and JP Morgan CreditMetrics, that are industrial derivations of Mertens Model that we considered in the previous classes. I will try to introduce these models, showing you how they can be considered derivations of Mertens model, that is to say, by removing some of the critical assumptions of Mertens model. And as you can imagine, these are models that most of the time are covered with patents and a lot of trademarks, so there are some parts of the models that cannot be disclosed. Actually, in class, I tend to disclose some things because I had the opportunity in the past to work with these models, also as a consultant when I was at the SAS Institute. But I will cut those parts from the online video because, I don't want to have problems with companies with respect to the fact that I might share some of their very dark secrets. But nevertheless, I will try to let you understand how these models work. And after dealing with these models, I will also say something about CDS, credit default swaps. That will conclude what we have to say about credit risk. And in next classes, again after the holidays, we will deal with market and operational risk until the end of our course. So what can I say? I hope you will enjoy this class and see you in a few weeks. Now, what we have done so far in the credit risk framework was to consider the LGD very, very briefly, so without entering into the actual modeling of the LGD, and to say something about how we can actually model the PD. So what we will do today is to continue dealing with the modeling of the probability of default, considering some other alternatives that we can consider as part of the internal rating-based approach. Obviously, these are just a few examples. There are many more examples. Very common approach is the use of the logistic regression. Now, someone is also trying a little bit of machine learning, but there is the problem that the regulator is not very open to these kind of things unless you are really able to explain what is happening in your algorithm, which is one of the weakness points of machine learning algorithms, especially things like neural networks. Now, the first model that we consider today is the model that was originally developed by KMV, and now it's part of Moody's, because Moody's acquired the model from the original company. So they actually acquired the company. So now it's called Moody's KNV. It's part of a branch of Moody's, which is the analytic part. And it's a so-called industry or proprietary model. It means that there are many patents on this model. It's not something that you can freely use. You have to buy the service from Moody. So what we will do in this example and in the following one, which is CreditMetrics by JP Morgan, we will say what we can actually say about those models, given the information available, but for example, the specific value of the parameters, if you want to know them, you pay Moody. When I was working a few years ago in a consulting company before starting my academic career, I was actually working in a risk department of a company that had agreements with these guys to implement these models into their software. It's a software house that also sells software to banks and insurance companies. And obviously, I had, at that time, access to the information behind those models in order to be implemented, obviously. But I'm pretty sure that from when I was doing that more than 10 years ago until now, many of these parameters have changed because of the continuous update they, in theory, make because of the new data available, the new evolutions of the model. Now, as I was telling you before, the model that we consider is the so-called Moody's K and V. K and V are just the first letters of the surnames of the guys that invented the model. The V, for example, is the Vasicek guy, so it's the famous Vasicek behind the Vasicek model for interest rates, for example. It was a model that was introduced in the 80s, in the late 80s, and then it evolved in several directions, and lately it was acquired by Moody's. Now, in order to understand how this model works, we will make use of what we already know, that is to say, Mertens model. Why do we do that? Because as I told you, Mertens model is a pretty theoretical model that is not really used in practice, but it's the prototype of structural model of default. And these models that are structural models of default inherit a lot of properties and from the construction of Merton. Now, if you are in the Merton model and you want to know what is the 1-year probability of default of your counterparty, what do you have to do? You have to compute the probability that V capital T is smaller than equal to capital B, where V capital T is the total asset of the company, but since we are interested in the 1-year probability of default, capital T would be 1, so V1. Capital B is the level of liabilities. You remember in the Mertens model, we have this very strange and specific bond issue that we use to finance our needs in terms of production or investments, and it represents the liability is a zero coupon bond that is issued at time zero with maturity a given time horizon. For us, it would be 1 year again. And there is no intermediate payment in between. There is default if the counterparty is not able to fully repay the debt obligation. So if the total assets of the company, V1, are smaller than or equal to the face value of liabilities, capital B. Now, if you take the formula that we have seen last time and you plug in the novelty, the only novelty is that the capital T and the square root of capital T disappears because now T is equal to 1. So at the numerator, the T multiplying the last set of parentheses disappears. At the denominator, we have square root of 1, so it disappears. So this is our probability of default under Mertens model over 1-year time horizon. Now, one first thing that we can do in playing a little bit with this type of models is to exploit the symmetry of the normal distribution. Now, if you consider the normal distribution, you know that it's, as usual, this guy here. And what we are computing there is essentially assume that here I have x, where x is the argument within the capital phi, so it's the log of b minus log of v0 and blah, blah, blah. What I can do, I'm just interested in this probability. This is what I'm actually computing. Now, because of the symmetry of the normal distribution, I know that if I take this symmetrically here, so if imagine this is minus 3, and I take the minus x that now becomes 3, what happens? It is equal to this probability here. Okay, so I can, instead of considering the probability of being below something, I can take the symmetric probability of being above something, which is just changing the sign and taking the survival function. If you do that, you can rewrite the probability in terms of what we will call Mertens EDF, and I will tell you what EDF means in a minute, in which the big change is that we switch the sign of the argument. So here we had the log of b minus log of b0 minus r and blah, blah, blah. We change the sign here, so now we have the log of b0 minus the log of b and so on. And because of the symmetry, I substitute the CDF, the cumulative distribution function of the standard normal, with the survival function of the standard normal that we indicate with capital Phi bar. Okay? Now, the EDF is the first, if you want, difference between Mertens construction and Moody's KNV. As I told you, in finance, there is this habit of giving fancy names to things. Most of the times, this is due not only to look fancy, but also because if it has a specific name and you want to use that name, essentially there is some trademark on that. Okay, so the EDF is nothing more than the expected default frequency. That is nothing more than the way in which in Moody's KNV you call the PD. Okay, in particular, the EDF, unless differently specified, is the probability of default within 1 year. Then obviously you can have the EDF over 5 years, 3 years, 2 years, whatever. But if you do not specify, is the probability of default within 1 year. EDF means expected default frequency. Okay. Now, what are the main differences between Moody's KNV and Mertens Model? Once we are in that setting in which we have switched from the CDF to the survival function and we have changed the sign of the internal part, so of the argument of the function, and we call that argument capital A, there are some changes that Moody's introduces to make its model more realistic and data-driven. The first one is they drop the assumption of normality. So instead of using the normal survival function, they substitute the normal survival function with an empirical survival function. Empirical survival function is, something that they estimate from data. Now, Moody's is a large rating agency. You can imagine they have a lot of data about defaults and about transitions to the different classes. In a minute, we will see how they do that. So the first big change is that they change the survival function of the normal distribution with an empirical survival function. Now, you remember that one of the points of criticism towards Mertens model was the fact that debt is just represented by that strange zero coupon bond and that there is no intermediate payment between capital time zero and capital T. Now, what they do in Moody is to change the capital B of Merton with what we call a sort of capital B tilde. That is a better representation of the debt structure of the company. Oversimplifying, you can say that capital B represents all the liabilities of the company that are payable within 1 year. So within 1 year means from now until 1 year, it can be at any time. So you already see the difference that instead of considering just default time capital T as in Merton, here we have the possibility of defaulting at any time. So it's already an interesting generalization. Finally, the argument A, that is that formula involving the log of B0, the log of B, R, sigma square V, and so on, is simplified. It's simplified and it is transformed into a very famous quantity, which is called the distance to default. Another term to give a trademark to something. Now, this quantity, the distance to default, is equal to that, is V0 minus, so it's the value of the total assets of the company at time 0, minus B tilde, which is this new measure of the liabilities that accounts for all the debt which is payable within 1 year, over sigma V, the volatility of assets, times V0. Now, how this quantity is obtained is through a series of approximations that we can very quickly observe here. So we start from A, which is that object there. Now, the first thing that they observe empirically is that if you take the last term of the numerator, so the difference between R, the risk-free rate, minus sigma square V over 2, this quantity, empirically speaking, in good market conditions, tends to be essentially zero. It's very, very close to zero. So you can set somehow safely to zero, and it disappears from the numerator. First thing. The second thing is that using essentially what we have seen when we were defined the different types of returns, so log returns and percentage returns, we can play well with volatility, they do something similar. So they switch from the difference of the logarithms to the percentage representation. Again, under certain assumptions that this can be done. It's not completely correct in general, but under quite general settings, this can be done. So this is the second. And then what they do, forcing a little bit the notation, is they substitute capital B with capital B tilde. Now, that ratio there, so V0 minus capital B tilde over sigma V V0, is what they call the distance to default. There is a saying from a financial point of view that reads the distance to default as the number of standard deviations of a company from default. Why? Because essentially the higher the distance to default, the lower your probability of actually default. Now, for what concerns the change of the survival function from the normal distribution to an empirical driven one, it is rather simple to understand how they do that. In practice, it's a little bit more complicated, but you can imagine the following. Now, Moody's has a huge data set, okay, of companies. For each company, for which those type of data that are needed here are available, what can they do? They can essentially compute the distance to default, okay? So they can create classes of distances to default. I don't know, between 0 and 0.1, between 0.1 and 0.3, between 0.3 and 1, between 1 and 2, and so on. So they can create classes. Then what they do, they just count over time how many companies in the different classes defaulted. So they can easily build an histogram for the different classes of distances to default. Using that information, they can have an empirical distribution function. The empirical distribution function is exactly what we did for the Bellet risk. You remember building our empirical distribution function. If you take 1 minus, you essentially have the survival function, okay? And that would be the object that they use there. So we will call that object f bar KNV. So f bar KNV is this empirical survival function. Obviously, the exact knowledge of that quantity is not public. So all in all, this is what the EDF is an empirical survival function computed in a quantity that is called distance to default. If you want, in this way, you see that Mertens model is nothing more, Moody's KNV is nothing more than Mertens model, in which they substitute different parts until they create a model that it is empirically sound and in principle more reliable because it relies on data that, at least compared to Gaussianity, to normality, are more reliable. They are not more reliable in general. Also, if you recall what the guys of Deloitte told you yesterday about blind spots and historical bias, but for sure, it's definitely more reliable than assuming Gaussianity everywhere. Now, this new probability of default that we call EDF has many advantages with respect to the basic PD of Mertens model. It accounts for default at any time until maturity. So maturity is typically 1 year, but if you define the 5 years EDF, it will be 5 years. So you account for default at any time. Default will no longer happen only at maturity. You dropped the assumption of normality, which is typically a weak a weakness of models, so it's a strong assumption that typically does not hold. And then what is nice is that obviously they have the data and they can easily sell these models, so this is nice for them. An important, and this is, if you want, an important characteristic and weakness of Moody's KNV, at least in this basic description I gave you, is the following. You may have two very different companies in terms of structure, in terms of market, in terms of country in which they play, in terms of many things. But in this model, if they have the same distance to default, they have the same probability of default. Okay? And the same distance to default can be obtained by the different combinations of V0, B tilde, and the volatility. So you see that this sometimes can be problematic because over-exaggerating, this is not obviously the case. If you have that the small shop on the market has the same distance to default of Apple, then they have the same probability of default, which is not necessarily true. In reality, one characteristic of Moody's KNV, which is in line with what we said with Mertens Model, is that this model works for traded companies. Essentially, it works for companies that whose information is publicly available on the market, for which you can, for example, read the equity value, for which the debt value is some liability value is somehow understandable from the balance sheet, which is freely available, and these type of things. This is not the type of model that you will use on a retail basis, for example, to finance a small shop, a small company on a much smaller scale. Another characteristic of this model, which is, for example, different from credit ratings that will pop up in the next model we consider, is that this is a model that takes into account values that are readable on the market, like the equity value, like the debt value, that are very contingent. So they are values that we read now in this specific moment on the market. So the EDF is an estimate of the probability of default, which is, if you want, point in time, PIT, point in time. It means that it gives a representation of the probability of default, which is contingent and linked to this very period. As I told you in the past, credit ratings, conversely, are through the cycle, TTC. They tend to average over long time horizons. So typically what you do, you use both tools. You want to know, for example, what is the average probability of default of a counterparty, and then you also want to know and to have an estimate of the specific probability of default at this specific time, okay? But in principle, they are different objects. Graphically speaking, the difference between Mertens and KNV is what you see in the slides. So in Mertens model, we have that the assets are modeled via a geometric random motion that moves. We know that the assets are log normally distributed, or the log assets are normally distributed. So essentially, your PD is the red area there of the fact that your V, a capital T, so VT, is below the liability level. If you consider, on the contrary, the KNV model, there is no actual modeling, not particularly explicit modeling of what happens between V0 and V capital T, that typically is V1, so T capital T equal to 1. The distribution that is used is empirical, and again, you will look for the probability, which is now the green one, to be in the tail of the distribution, and the level that you use to define the threshold is essentially the new liability level. Okay, so heuristically, that will be the difference between the two models. But you see that they share a lot of common parts, or at least it is known that Moody's KNV derives from Mertens model. Now, another model of this family of industry model is CreditMetrics. Now, CreditMetrics is a model that was introduced in 1997 by JP Morgan. In 1997, if you open a book about credit risk, you will find that most of the models that have been introduced in industry, not in the academic literature, but in the industry, are around 1996, 1997, 1998. Why? Because these were the years in which, obviously, if one of your competitor comes out with a model, you want to come out with another model, first thing, but also because it was the period in which it started the big discussion about regulating the banking sector. Okay, so you can imagine that providing these models, when you know that banks will be obliged to use models because of the foundation internal rating based approach, the advanced internal rating based approach, and so on, it's something that, if you are in that type of business, is important for you. It's, again, a model in the Merton family, in the sense that you can read that as a derivation of Merton. There is a very important difference between CreditMetrics and, for example, Moody's KNV or Merton itself. And it's the fact that CreditMetrics is a model that not only deals with the probability of default, which is in common with the others, but is also a model that deals automatically with another subtype of risk that we have considered within the credit risk family. You remember we had the default risk, and default risk is the PD, the probability of default, but we also had migration risk. That is to say, the probability that there is a downgrade of my counterparty, moving from a given rating class, say a class in the A area, to a class in the B area. The model by JP Morgan accounts for that. So an important difference between Moody's KNV and JP Morgan, for example, is the fact that CreditMetrics also account for migration risk. Again, in these very basic representations. Then all companies have more advanced models. Now, the big difference between the approach of Moody's and the approach of JP Morgan is the way in which the threshold mechanism that is behind every structural model of default is defined. In Moody's, it is very similar to what Merton does. That is to say, instead of using capital B, the liability level, they introduce this capital B tilde, but still, it's something similar. So they use liabilities. In CreditMetrics, on the contrary, the different thresholds are obtained via ratings. So CreditMetrics combines ratings and structural model of default. Now, you can imagine that if you are interested in this type of model, the type of ratings that will be used to build a model are not the ratings that you freely find on the market or the ratings of Moody's and Standard & Poor's. There will be the ratings that they provide you on the basis of what they know, on the basis of their internal rating abilities. But let's say the following. Consider that we have a company and that this company has some rating. So it has been assigned a rating. We say that it's in the B class, so the yellow row in the table. And this is at the beginning of time in our time horizon that we call 0. So today it is day 0. Now, if you have the transition metrics, as we know, we typically have with credit ratings, we have a table that tells us what is the probability that our company B will become a AAA over the time horizon. So if the time horizon is capital T, that table tells us that the probability that our company moves from B to AAA is essentially 0 over a capital T time horizon. It is 0.11% to move to a double A. It would be very large to stay in the same class. So in the B class, it's 83.5. And the probability of defaulting in the period between 0 and capital T is around 5%. Okay, these are things that we read from the ratings. Now, one thing that we know from Mertens model, that again is behind this type of construction, is that if we assume that the asset of the company follows a geometric Brownian motion, okay, which is the same type of process that you have used in Black-Scholes, if it is a geometric Brownian motion, what do you know? You know that the value V capital T, the total assets of the company, will be log normally distributed, or the log of Vt will be normally distributed. In CreditMetrics, the assumption of geometric Brownian motion is maintained. In Moody's KNV, it is dropped and substituted by these empirical data. In CreditMetrics, it is maintained. So what we know is that log Vt is actually normally distributed. Now, every normally distributed random variable, if it is standardized, that is to say, we remove its mean and we divide by the standard deviation, then defines a new random variable which is still normally distributed, but distributed according to a standard normal. That is to say, a normal with mean 0 and standard deviation 1 or volatility 1. So what they do, they actually do the following. They take the log of Vt, which is the quantity of interest, they remove the average, and the average is nothing more than the log of V0 plus R minus sigma square V over 2 times T. They take minus of that, so all the signs change, and they divide by the standard deviation. The standard deviation in a geometric Brownian motion is essentially dependent on the Brownian motion part, and you know that it is a function of time. So that standard deviation, therefore, is the volatility sigma v times the square root of t. So essentially, xt is the new quantity that they consider, which is nothing more than the standardized version of the total assets of the company. But if this is the case, now what they can do, they can essentially compute the thresholds in a way very similar to what we have done when we were playing with the valid risk. That is to say, since we know that we're playing with a normal distribution and even a standard normal distribution, if I'm interested in the thresholds, then I can use the quantiles of a standard normal distribution. So if this is the theoretical distribution that you see there, I can find values such that if I'm below a given value, I'm in the default class. If I'm between that value and another value, I'm in the C class. Otherwise, I'm in the B class, in the AAA class, and so on. The way in which these thresholds are obtained is rather simple. So again, consider this table. This is the table of, this is the transition matrix in 1 year. Okay, so we are considering, for example, all the transition probabilities for a B-rated counterparty to move to AAA, AA, and so on. This matrix here, just to change a little bit, is actually based, is not very updated, but it's actually based on real data that I took from Moody's. Okay, so it's a sort of blasphemy to put the Moody's matrix within CreditMetrics, but still, since I don't have the JP Morgan matrix, I use this one. Okay, so imagine that again we are considering the light green row. Now we want to compute the different thresholds that we want to use in our model. How can we do? So the first thing is to consider, and obviously we are not computing the quantity here, is to consider the rescaled asset value or the standardized asset value. And we know that this value is xb, so we have computed this value. Now, this value will move over time, okay, because of the dynamics of the company, because the asset value of the company will change over time. And looking at where this value will be, we can understand if our counterparty will go default, it will stay in the same rating class, or will improve its rating, or will worsen its rating, all the different possibilities. So the probability that a B-rated company will become a AAA class, if you look back to this table, it is 0.01%. Okay, it's exactly this value. The probability of defaulting, conversely, is 4.73%. Okay, these are data that I took from a record. Okay, how can we use this information to define the thresholds of the model? Because we need the thresholds, since this is a structural model of default. Now, it's the following. We start from the default. So default is the worst class, okay? And is also an absorbing class. Why? Because if you move from B to B minus or to B plus, you can always come back. If you move from B to default, you stay in default because you defaulted, okay? Now, what happens? If I want to compute what is the threshold, I take the value 0.0473, which is 4.73%. And then what can I do? I can just apply, as we did when we were playing with the Velet risk, the quantile function of a standard normal. Why? Because in this model, the standardized asset value of the company, or the rescaled asset value of the company, whatever you want to call it, it's normally distributed according to a standard normal. So I can take my table again. I can obviously write the code in R if you want, or in Python, or Excel, or as you prefer. Otherwise, I just take my table there, and I look for a value which is close to 0.0473. That value here, you see, is here. This is 0.475. We can take it to be quite close to 0.473, so we can pick that value, and that value tells us that the quantile, the corresponding quantile, is 1.67. So this is the value we will take from the table, 1.67. The actual value is 6716, so you see they are actually quite close. So the table does its job quite nicely. So what does it mean to have that number? That number tells us that if now the value of our company, the rescaled value of our company, is 2.5, but in 1 year from now, according to our prediction, will be below minus 1.67, essentially our company will go default. Okay? So we take the balance sheet of the company, we can compute all the quantities, and we compare that quantity with the critical values that we get from the standard normal distribution. If X capital B is smaller than 1 minus 1.67, our company is in the default class. So what we will call minus 1.67 is default threshold. Now, the default class is not the only class we can consider. There are other classes that we can consider. For example, if you go back to the previous table, you see that there is another class, which is the CAC class. The CAC class is in this table, the second worst class. It's just a little bit better than going default. Okay, so if I want to compute the probability for my company to go to the CAC class, that probability is given there, is 0.74%. But now I want to translate that probability into thresholds that I can use if I compute the rescaled asset value of the company. How can I do that? In this sense, it's again quite simple. So the probability, if I'm under the normal distribution, the probability of defaulting is this probability here. That is to say, I'm below the value that I had computed, which is minus 1.61. This is the default class. Now I want to find this threshold such that I can compute this area, and this area will be equal to the area of being in the class CAC that we have seen was 0.74. So I want to find this value here. Now, to find this value here, what can I do? The lower part of the interval is already given. It's the default threshold. I need only the upper part of the interval. And the upper part of the interval will be given by summing this probability here, the default probability, and the probability of being in the CAC class. So the probability of defaulting is 0.0473. The probability of being in the CAC class is 0.0074. I sum these two quantities, I apply the quantile function, and I find a value which is minus 1.60. Okay? Obviously, these scales are totally not representative, but you understand what we're doing. So every time, what you have to do is to keep on accumulating the probabilities from the worst to the best class. The lower bound is always given by the previous threshold that you have computed as the upper bound of the previous class, and the new upper bound will be what you actually have to compute. So if you want to know what is the threshold, the combination of thresholds defined the CAA class, it will be minus 1.6 and minus 1.17. And you go on in this way. Now, at the end, you will reach the last class, which is the AAA class. And the AAA class, in that case, there is the double possibilities. You can either start on accumulating from left to right if you want, or since you are here and you are interested in this probability and you have that probability in the table, that probability for us is 0.01%, you can take 1 minus 0.01%. And immediately you have this area here, and you can compute this threshold here. So if you do that, you find that the value is, I don't recall, is 3.71. So if, looking at the balance sheet of our company, we find that initially it was 2.5, and then because of I don't know what, it becomes 3.87, it means that our B-rated company is now in the best rating classes. So you see that with this model, we can actually, by looking at the balance sheet, computing the standardized asset of the company, and then comparing with the thresholds that we can easily compute using the standard normal tables or the code, obviously, I can decide what is happening to my company. I can take all the decisions I want. Here you will find the computation using the tables and using the code if you are interested in the code.